Dear friends, welcome to the monthly outlook on markets. This month, we will talk about two important aspects. First, the new money raised by corporates, and second, the cut in US Fed fund rate. Let's start with the money raise. India has actually been a paradise for entrepreneurs raising money. Even multinational companies who resisted from raising money in India are raising money here now. India now is the largest country within Asia in terms of share sale, garnering close to 32% of the total share in Asia versus 13% previous year. So far, around $42 billion has been raised in India. This is an increase of 61%, while new and additional share sales in Asia has slumped by more than 30% in terms of value in calendar year 24 till date. The biggest impact was seen in Hong Kong and China. China saw a steep decline of 68% in money raise and 58% reduction in issues. This money raise is giving rise to new energy and entrepreneurship in the country. The urge to grow faster in the rapidly evolving opportunities in the country has increased. Balance sheets of the corporates have also improved pretty significantly. However, this money raise will also lead to increased competitive environment. Consequently, we believe one has to be very mindful of the investments and back those managements which has execution prowess, can navigate the competitive environment, are operating in areas where opportunity is secular, and also capital efficiency of those businesses being very superior. Let us now move on to US Fed fund rate cut. US Federal Reserve has finally started with a 50 basis point cut in interest rate as the confidence increased that the inflation in US is normalizing towards the target rate. The US economy has slowed but remains on a decent footing. The US Fed does not want its economy to deteriorate further. A slow growth with controlled inflation now seems within reach. In the past, falling interest rates have often coincided with market declines, as the decelerating economic conditions have overshadowed the perceived benefits of lower rates on profit and loss and cost of capital. Past rate cuts, such as those that we have seen in 2001, 2007-8, led to significant market downturns. However, in the current scenario, the drop in interest rates is in response to the falling inflation and slow economic growth. This scenario is different from the past, and hence we believe the past playbook may not work. Let us now see what could be the impact of this event on different sectors. In general, we believe quality businesses that have higher value coming from long-dated cash flows or terminal growth should have relatively higher positive impact. We already started to see outperformance of high-quality growth-oriented businesses. Nifty Quality Index has now been outperforming Value Index for a few months now. Also, non-banking financial corporations tend to gain more versus banks in the initial stage of rate cut cycle. These companies typically benefit from lower borrowing costs, which can improve their margins and ROE. We do not believe IT software businesses improving sharply as the global growth continue to remain anemic. Indian software services growth may improve from the current lows to long period averages. Post the election outcome and the rate cut, non-cyclicals like consumer, technology and healthcare have outperformed cyclicals like capital goods, many PSU stocks, infrastructure-oriented businesses. As we have been highlighting, given the converging business performance across ownerships and market caps, we believe the sharp performance divergence may not recur, and markets will be more rewarding to performing businesses versus the others. Markets from here on will be more driven by bottom-up ideation. Indian economy performance has been resilient so far. Corporate earnings are expected to grow close to 15% CAGR over next 2 years. FII holdings in BSE 500 is at multi-year lows, suggesting room for reinvestment, especially in a rate cut cycle now. Additionally, the upcoming quarterly financial results will be under the microscope, especially after the impact of election and severe heat waves affecting performance in the quarter gone by. Quarter 2 of this fiscal year is expected to be a quarter of slow improvement before we see acceleration. At ASK, we are focused on manufacturing, engineering, infrastructure, consumer, healthcare opportunities. Indian manufacturing is cashing on Make in India for India and Make in India for the world. Supply chain dislocation is an opportunity that has long runway. Also, the improving demographics and the resulting consumption patterns is presenting huge opportunity in consumption space, especially discretionary. Thank you.